Okay, let's unpack this. Think about, the world around us, buildings, roads, bridges. What's the fundamental material holding it all together?
Cement, absolutely. It's foundational, literally, to our infrastructure, our economy.
Exactly. Easy to take for granted maybe, but the health of the cement sector, that's a really powerful indicator of, well, broader economic activity.
For sure.
And that's why we're doing a deep dive today. We're looking at a specific snapshot, a research report, giving us an ear-to-ground perspective on the cement industry, specifically in India.
Right. This report gives us a recent pulse check. So our mission here is to sort of cut through the data, figure out the main findings about prices, demand, what's happening with costs.
And crucially, what the experts are projecting for the future, right?
Exactly. What are the absolute key takeaways you need to know from this snapshot?
Okay, so let's jump right into the current landscape. Starting with prices, the headline from this report is that pan-India cement prices took what they call a seasonal breather in May 2025.
A breather, yeah. Meaning they were largely flat, pretty much unchanged compared to April.
But the crucial context here, and this seems important, is that this flatness came right after a really sharp hike in April 2025.
Oh yeah, prices jumped significantly then around, what was it, INR 45 to 50 per bag across the country.
So May was really just a pause after that big climb. The report gives the specific May 2025 national average figure, INR 388 per bag.
388.
And even though it was flat month over month in May, that's still up quite a bit year over year, about 7 to 8%.
Well, right. And actually the highest average price nationally in like the last 15 to 17 months, so still elevated.
And that national average, as always, it doesn't tell the whole story, does it?
No, not at all. If you look at the period covering April and May, what we call quarter to date, or QTD, for the first quarter of their financial year.
Which is Q1 FY26.
Right, 1Q FY26. Pan-India prices were still up about 4% sequentially, quarter over quarter.
Okay, and here's where it gets really interesting, showing the complexity. The report points out big regional differences. The South, for instance, a massive price jump QTD.
Yeah, huge. Up 10 to 11% quarter over quarter down south. The East was also up maybe 4 to 5% QOQ.
But other regions were different.
Yeah, meanwhile, places like Central, North, and West were, broadly flat QOQ.
And just looking at May compared to April, it's even more mixed.
Even more varied, yeah. The South actually saw a little dip, like INR 5 a bag in May, but that was after that huge April jump, remember?
Oh, okay.
Central and North were down slightly, maybe INR 2.4, but the East and West actually saw small increases in May, INR 2.4 again.
So what does that regional variation in May tell us? Seems like the April momentum just didn't stick everywhere equally.
Pretty much. The South maybe corrected a tiny bit after running up so hard. Other places just saw minor tweaks during this so-called breather. Suggests local factors are definitely at play.
Right, local market dynamics.
Yeah.
Okay, what about demand then? Demand in May 2025.
The report suggests it was broadly flat year over year. Although month over month, it was actually up high single digits after a soft April.
But that pickup didn't fully materialize.
Correct. It was impacted by a couple of things, the report flags. Partly those Indo-Pac cross-border tensions, which affected the North for a few days.
Okay.
And importantly, the early start to the monsoon season in many parts of the country, always a factor.
Always a factor, yeah. Monsoon slows construction, so connecting those points. Quarter-to-date demand, so April and May combined.
Likely only grew in low single digits year over year. Not huge growth.
And the North is singled out.
Yeah, the North is specifically called out as probably the only region expected to have seen an actual decline year over year in QTD demand.
Okay, so national price is flat in May after a big jump, lots of regional price variation, and demand kind of flat YOY hit by the monsoon and those tensions.
Exactly. And this current state, especially the early monsoon and that demand softness, leads the report to suggest, there might be some near-term pressure on price momentum.
Which could mean?
Well, consequently, the report notes stock performance in the sector might remain range-bound, sort of stuck fluctuating within a certain price band, not really breaking out upwards in the immediate future.
It's an interplay. Seasonal factors hitting up against the underlying demand picture.
Precisely. That's the near-term view.
Okay, let's shift gears a bit. Let's look at the cost side. Hugely important for profitability.
Absolutely. The report touches on the key inputs diesel, coal, petcoke.
Petcoke is a big fuel source, right?
A major one. And the report specifically highlights international petcoke. Spot prices for that are down, roughly 7% compared to the average price they saw in the last quarter, Q4 FY25.
Okay, 7% down. Do they give numbers?
They do. U.S. petcoke, the cost including insurance and freight delivered to port, that's CIF, is now around USD 103 per ton. And the landed cost after duties and everything is about USD 118 per ton.
And they even suggest a reason for this drop, something about trade tensions.
Yeah, interestingly, the report suggests the recent thaw in U.S.-China trade tensions has maybe created some positive sentiment, eased things up a bit in the supply chain.
Ah, it's fascinating how global politics can trickle down to input costs like that.
It really is. The report also notes other trends, though. International coal prices also declined, about 5% quarter over quarter so far in Q1 FY26.
Okay, so coal down too.
But domestic petcoke prices actually increased 12% year over year, although they were flat month over month. So a bit of a mixed signal there.
And diesel.
Diesel prices, meanwhile, have been pretty stable lately.
Okay, so it's a bit of a mixed bag on cost, like you said,
Mm-hmm.
but maybe some potential help from lower international petcoke and coal.
Seems that way. And looking further out, the report mentions management discussions from the end of last fiscal year, 4Q FY25.
What did they suggest?
They suggested potential for sustainable cost savings, maybe INR 150 to 200 per ton over the next couple of years, which would be quite significant for margins.
Definitely significant. Speaking of margins and profitability, how did these companies actually finish the last financial year, FY25?
Well, the report details a strong finish for the companies they cover, and that's a big chunk, about 65% of industry capacity.
Okay.
In Q4 FY25, their aggregate EBITDA grew 12% year over year and a massive 66% quarter over quarter.
Whoa, 66% quarter over quarter. That's huge. What exactly is EBITDA again? Just quickly.
Right, good question. EBITDA is earnings before interest, taxes, depreciation, and amortization. It's basically a key measure of operational profit. Think of it as the cash generated from the core business before financing costs and non-cash stuff like depreciation.
Got it. So a 66% jump Q-o-Q shows that last quarter was really strong operationally for these big players.
Very strong. The blended EBITDA per ton figure for this group hit INR 1,099 per ton in Q4 FY25.
And how does that compare?
It was actually flat compared to the previous year, Q4 FY24, but up a very significant 33% compared to the previous quarter, Q3 FY25. That's an increase of like INR 273 in profit for every ton sold just quarter on quarter.
Okay, so a strong finish to FY25 sets the stage. What are the projections looking like going forward, say FY25 to FY28?
Yeah, the report looks out over the next few years. They expect sustainable volume growth, so more cement being sold around 6 to 7% per year.
And what's driving that expected growth?
Well, the report points to the government's continued focus on infrastructure, roads, ports, etc., plus housing projects, and also just increasing demand from both rural and urban areas.
So they see this as more than just a short-term bump, like a multi-year trend.
Exactly. They see it as a multi-year growth story.
And the CER projections, the compound annual growth rates, they probably reflect that.
They really do. They paint a picture of this expected long-term trend. For the coverage companies, they're expecting around a 20% EBITDA CAGR over FY25 to FY28.
20% growth in operational profit each year, on average. That's strong, especially after.
Especially considering FY25 saw about a 10% decline overall. So it's projecting a really solid recovery and then strong growth.
So not just bouncing back, but significant multi-year profit growth expected. What about the profit per ton?
Yeah, EBITDA per ton, that operational profit per unit, is projected to increase quite a bit. From INR 844 in FY25 to a much healthier INR 11,177 is the projection for FY28.
That's a substantial jump in expected profitability for each ton they sell.
It is, and looking at the weighted average for the industry as a whole, not just the cover companies, the report projects volume growth at a pretty robust 10.7% CAGR.
Okay, so the total amount of cement sold is expected to grow by over 10% on average each year over this period. That's significant volume.
Very significant. While the weighted average industry realization growth, that's basically the average price they get per ton, is more modest, projected at about 1.7% CAGR.
I see. So the story isn't really about getting much higher prices per bag.
Not primarily, no. It seems to be more about combining that, modest price increase with really significant volume growth, plus those potential cost improvements we talked about.
Right. And putting those factors together leads to
a weighted average industry EBITDA per ton growth projected at a very healthy 11.7% CAGR over the same FY25-28 period.
Okay, so that's the strong growth story they're projecting.
Yeah.
Does this lead the research firm to recommend specific companies?
It does. This projected growth leads them to highlight specific top picks.
Okay, who do they like?
In the large cap space, so the bigger companies, they name Ultratech, rated as a BUY.
Tech, okay, and mid-caps.
And in the mid-cap space, their pick is JK Cement, also rated as a BUY.
Got it. Ultratech and JK Cement is BUYs, but they cover others too, right?
Oh, yeah. The report covers several others, ACC, Ambuja, Dalmia, a few more, with a mix of BUY and Holdy ratings.
And they define those ratings.
Yes, they do. A BUY rating means they expect total returns, so price appreciation plus dividends of more than 10 or 15% over the next year. Depends on the company's size.
Okay.
While a holding rating means they expect the price to move within a certain range, maybe from a 10-15% downside up to about a 10% upside, so it gives you context for those picks.
All right, so bringing this all back to you, the listener, why does digging into a cement report for India actually matter?
Well, understanding the cement sector, it's kind of like taking the pulse of construction and infrastructure activity. And that, in turn, is a huge driver for the whole economy. It impacts jobs, infrastructure development, even the cost of housing or office space.
Absolutely. And this report reveals a really interesting dynamic, doesn't it? On one side, you've got the very current situation, what they call that seasonal breather.
Right. Temporary softness in prices and demand in May, influenced by things like the early monsoon, those border tensions, specific regional stuff.
But then on the other side, you have the report's clear vision for the medium to long term, which is
a strong structural growth story, driven by government spending, fundamental demand, leading to these projected double-digit CAGR growth numbers in industry volumes and profitability per ton over the next few years.
which leads us to a final thought, maybe something provocative for you to consider. The report calls this current moment a seasonal breather, expects near-term stock performance to be kind of range-bound. Yet at the same time, it projects really significant multi-year growth and profit improvements, and even calls specific stocks BUYs.
Right.
So the question is, how might this temporary pause, this breather that's influenced by maybe seasonal things like the monsoon, how does that actually interact with or maybe impact that really powerful long-term structural growth story tied to infrastructure and housing?
Yeah, does it create a potential, entry point for investors, or does it maybe signal some underlying volatility that the long-term view might be underestimating?
It's that tension, isn't it, between
Yeah.
the short-term wiggles and the long-term trend. That's what makes understanding these foundational sectors so critical.
And so interesting. Definitely something worth keeping an eye on.